So basically, we are going to today understand hedging currency risk. Fine. So this is we are moving away. We are just going back to the when we started. Originally we are talking about forex markets. You are there. You attended first few two lectures. Huh? Okay. Okay. So we are going to start now. Fine. Please take your seats fast and be try to be. Somewhere here rather than the corner. So should we start? Okay. So the topic today is hedging currency risk. We are exposed to foreign currencies whenever we are doing business. And this is in continuation of our topic called forex markets, which I started with originally. So we just continue. This is the last leg of this, topic, which is hedging currency risk. So ultimately, why we study this subject? Because we want to hedge our currency risk. Okay. So there are basically it is the way for a company to minimize and eliminate forex risk. We are exposed to foreign currency risk whenever we do business. We can be exposed to dollar, pound, euro. So we trade with many countries. So we buy certain things or we sell certain things. We import, export, and sometimes we make a payment after some time, and the foreign currency can exchange rate can change and cause kind of a loss to us, or even can cause gain to us. So how do we hedge this currency risk? The topic is basically covers forwards, futures, and options, which I think the other students who have not come there, attending for forward, future, and options for stock market, but we are doing the same thing for currencies. Okay, so there are two kinds of techniques through which we can eliminate or somehow manage the foreign currency risk. One is called the internal techniques. So this is basically done by the business itself. So it doesn't require the help of any other third party. The business is trying to protect itself against the unfavorable currency movement, which can lead to a higher payment or less of remittances from abroad, because the currency may change not in your favor. So there are internal techniques. Okay, which is done by the business itself. The second one is external techniques involving third parties. So either you do internally, how do you manage your foreign currency risk, or second is that you can do it with the help of a third party. So there are two, okay, mainly. So the first is called the leading and lagging. Okay, fine. So the first technique is called leading and lagging. So leading means advancing a payment. Okay, suppose you have to make a payment to someone in foreign currency, you make a payment early, because if you think the dollar is going to appreciate significantly in the next few days or months, so you make the payment early so that you don't lose on account of the dollar appreciation if you are importing. Okay, while you are exporting, you're going to get a payment from someone after some time, so you can ask for a prepayment. You can prepone the payment or ask your customer to make the payment as early as possible, so that you don't lose money on account of the unfavorable currency movement against you. So let's take an example here. So this is the example. So X Limited imports 1 lakh goods from abroad. Okay, so the person has imported goods of 1 lakh. Okay, the current rate of dollar is $1 is 82. Now the money is payable after 6 months. Okay, so you have imported certain things and you are supposed to make a payment of $1 lakh or $100,000, and you have to make it a payment after 6 months, and you expect the dollar to appreciate. So what you can do is, so this company expects the dollar to appreciate significantly in next 6 months. So he plans to pay the amount upfront, which means that you can make the payment upfront so that you don't lose money. Suppose the dollar goes to say 85, so you're going to lose 3 rupees per dollar, almost a loss of 3 lakh rupees in case if you make the payment on the due date. So you make an early payment. Is that okay? Fine. So we have just started, so we haven't missed the first slide. So then of course we talk about lagging, leading and lagging. So what we have done is basically we have done is lagging. Now we are talking about leading. Okay. So, for example, Indian firm which is due to receive payments from its customers from UK. Okay. So there's a customer you have, supplied your goods to England, and you're expected to receive some money from the company. Okay, after a certain time. So so he may you may try to get the payment early if you expect the pound to depreciate or to fall. Today, suppose the rate is 102, and at the time you are going to receive the payment, it goes to 95. So you're going to get 95 rupees per hundred per one pound, whereas today rate is 102. So if you ask your customer to pay immediately, so that you can convert the dollars or pounds at 102, so you get a better payment. Is that okay? Fine. So, so just to cover up again, so we're talking about techniques of hedging foreign currency risk. Okay, so there are internal techniques or external techniques, and we are discussing internal techniques. Okay. Anyway, I'm recording the lecture, so you can always listen if you missed out some points or come late. So the first was called the leading and lagging. The first technique is called the leading and lagging. Now, if you are an importer and you have to make a payment to someone for your exposure in dollars, and you have to make a payment, say, after some time, 6 months, so you can pay immediately, because if you expect the dollar to significantly appreciate against the rupee, so you can upfront make the payment so that you don't have to make a higher payment at a later date. You have to make a payment in dollars, that will be the same. But when you ask the bankers to give you dollars, he'll be giving it higher rate if it happens to be after 6 months, and if it happens that the dollar goes up, okay, from say currently 82 to 85, so you have to pay 3 rupees extra for the currency, moving in the other direction, not moving in your direction. Okay. Similarly, as an exporter, if you have to make a payment to your customer, or sorry, you're going to receive a payment from your customer, and suppose he happens to be in pounds, and you have exported goods to England, and today the pound is 102, and when you get the payment, say after some time, the pound falls to 95, so you're going to lose 7 rupees per pound, isn't it? So if it happens that you can ask your, customer to pay it early, of course he will not pay, but you can give him some kind of incentive, so he will pay the money. So you're not going to lose that $7. Okay, so this is called uh, leading your receivables. So you have leading and lagging techniques, which are internal techniques, where the company is not using any third party. So we are not entering into any forward contract or futures or options to manage the currency risk, but this is through internal techniques. Okay. In case if you don't follow, please ask me a question. I'm sitting because it's getting recorded. Okay. So I can't use the board at the moment. I'll use it wherever is required, but then my voice will not get recorded properly. Okay. So the other internal technique is invoicing in domestic currency. Yash, can you read? Yash, hai na aapka naam? Can you read?
Invoicing in domestic currency, it's an export. An exporter can show transaction risk to its customer abroad.
So here, when you are instead of invoicing in dollars or pounds or any other currency, you invoice. If you are sending goods to someone, you invoice in rupee. Now the government of India allowed that rupee invoicing recently in case of when the Ukraine and Russian war broke. So we were raising our invoices in rupees, with the countries which are accepting our rupee invoice, because then the other country has to pay in rupee. He will not be allowed to pay the money in his own currency. He has to make the payment in rupee. Okay. So what happens there? Because when you are exposed to foreign currency, then the risk is yours. Okay. Like suppose the dollar moves up or dollar moves down, if you're an exporter, you're going to lose money. If the dollar is 80, say 3 today, and it goes to 80, then you're going to get 3 rupees less as an exporter. Okay. If you have, invoiced in dollars, but if you have invoiced in rupee, then he is going to pay you that much of rupee. Okay. So then you're not taking that risk, but somebody else is taking the risk, your customer or your supplier. Okay. So it all depends upon your customer and supplier whether he's willing to take that risk or not. Okay. So, for example, X Limited invoices rupees 82,000 for the export. Now, he has raised a bill in Indian rupees, okay, to his customer at how much rupees? 82,000. At the time of export, the dollar was equal to 82. Now he is going to receive the payment after 6 months. When you supply the goods, you give sometime a credit to your customers. So your customer is supposed to make the payment after 6 months. Okay. So you were thinking that the Indian rupee is going to appreciate and the dollar is going to depreciate. So that's why you invoiced in the rupee. Otherwise, you have lost the money. Okay. If the Indian dollar would have depreciated, it would have come to about say 80, and you have got 80 rupees per dollar instead of 82. So you said 80,000. I'm going to raise as an invoice. Now $1 is 80. Now it happens that the dollar after 6 months actually depreciates, and the rupee is equivalent to dollar is equivalent to 80 rupees. But he is going to receive 82,000 because your customer is going to pay you 82,000. So importer has to pay now. He has to, he was supposed to pay $1,000. He will be paying $1,025 because now he has to shell out more dollars. Okay, had the currency remained at 82, then he would have paid $1,000. But now the currency has Indian currency has appreciated against the dollar, so he is going to pay 1,025. Okay, he is going to pay that much of money to the banker, and the banker will release 82,000 to my customer or the customer himself. I mean the X. So he is going to receive. That means he is not exposed. Okay, but such kind of a things normally don't happen because when you are trading with someone, he would ask the invoice to be raised in his own country. Okay, suppose I am a German, so I would say raise the invoice in euro. If I am in England, I would raise, I will ask my, I mean, the invoice to be raised in pounds. Okay, so your customer or your supplier is not going to take the risk of the other currencies, this thing, countries, this thing. So this is only when it happens like that. Okay, then, Haji. No, here I'm saying that the other guy, if you're raising the invoice and you are selling goods to I mean another country, so you have to raise the invoice in the foreign country. Okay, fine. Suppose I'm sending my goods to England. Now they will ask me to raise the invoice in pounds, but I'm raising in rupee. Okay, now the customer says if he's okay with that, then only you can raise it. Otherwise, not. Because normally 99% chances that he's not going to accept a rupee invoice. But during the Ukraine-Russia war, it happened that many countries were accepting the rupee because there was some kind of a ban put on on dollars or other currencies. So in that case, it was there. Fine. Okay. So internal techniques. So yet another technique is called netting. So what we are doing is basically we are trying to understand how a company manages their foreign currency risk. Okay. Fine. So, and there are certain techniques which are called internal techniques. So we are in the topic called internal techniques, and we have done two techniques. One is called leading and lagging. Okay, leading and lagging would means that you are either making the payment little later. Okay, sorry, you are making the payment immediately instead of on a due date because you don't want to get exposed to the dollar. The dollar appreciates, you have to pay more, so you pay the money upfront and avoid a loss on account of dollar appreciation. Now, then the second was invoicing in the home currency. Like if you are in India, if my customers or my suppliers allow me, or rather my customers allow me to raise, invoices in Indian rupees, then I'm not exposed to the currency risk. But that will be a very lesser case. Okay. Then the third technique, what we are doing is called netting. Here, it may happen that let's read. Yash, can you read?
Exposure netting is a method of hedging currency risk by offsetting exposure in one currency with exposure in the same or other currency.
So basically, if you are dealing with someone, you're supplying to him, he's also, selling certain goods to you. So you have, dues with each other. So you can settle by netting off. Okay. Whether it can be in the same currency or it can be another currency. Let's take example. Just read, Yash.
X India Limited owes $1 million to its group company X
No, it's not 1 million, it's $100,000. Okay. Or 1 lakh dollars, whatever you can call it. Yeah.
Yeah. For the goods supplied, and X USA Limited also owes $80,000 for the services provided to X India Limited.
So both the companies have respective dues, so they can always net it off, and only the balance can be paid. So that means the foreign currency risk is eliminated to the extent of netting. Okay, it can be in the same currency. It can be in the different currency also. Let's take an example. Just read the example.
Ex India Limited owns 100,000 to company ex UK Limited for the goods supply, and ex UK Limited also owns 78,000 pounds for the services provided to ex India, and $1 is equal to 0.78.
So in this case, they are dues to each other, and at that time the dollar was equal to 0.78 pounds. So that means that the net off will not involve any kind of a payment. So you have to, you know, now you have to pay $1 lakh, but you are supposed to receive 78,000 pound, which is equivalent to a $1 lakh because the exchange rate is almost the same. I just give an example. It's just a coincidental thing. Otherwise, you can settle only the difference. Is that okay? Is it clear? Then we have some techniques. So these are the most important techniques. Okay. So please pay attention. Now we have reached to the point where things become a little bit, tricky. Okay. So we're talking about forward, futures, options, and swap contracts. Now forwards are basically, contracts which you enter with. Of course, here the third party is involved, the banker generally. Okay. So you go to a bank and seek a forward cover. Okay, like suppose I have to make a payment to someone in dollars. Okay, so and the payment happens to be say after 6 months or after 3 months or after 9 months or after 1 year. Then who knows what will be the rate of dollar versus rupee? Normally, what happens? The dollar appreciates against the rupee. Normally, this is the trajectory over the years. So and it happens that it can even sometime go at a very high rate, because currently what is happening is the dollar index, which was close to about below 100, has gone to 106, 107, which means the dollar is appreciating against all the major currencies. It happened about a year back or year and a half back when the Ukraine Russia war broke out. So dollar index has gone up to 112. So at that time, all the major currencies, they depreciated against the dollar, or dollar appreciated significantly against all the countries. Okay, like from against Japan, the Japanese currency depreciated almost like 30% against the dollar. Okay, now we are witnessing the same kind of a story, and because the dollar index, which is an index comprising of say 5 or 6 countries in the world, which gives you about the sense of the dollar movement. Okay, so the dollar has again started appreciating against all the major currencies, and it has gone to a level of 107. So you have already seen that rupee has also depreciated. It was around 81, it's now close to about 83. Of course, Indian rupee is quite has a strength. It is not moving that much as against Japanese currency. Japanese currency is close to 150, yen against $1, which was about a month back around 130 yens against $1. So maybe that we are still, holding our fort, that we are not depreciating so much, but we have also depreciated. Okay. So in that case, if the depreciation happens to be of a great magnitude, you're going to lose a lot of money if you have to make a payment to someone, in dollars or in any other currency. Okay. So what is a recourse? Now, first recourse is that you can take a forward contract. You can go to a banker, okay, and ask to give a quote for dollar, which will coincide with the payment when you have to make the payment to someone, or when you're going to get the payment from someone. Suppose you're going to get, you're an exporter, you're going to get a payment after 6 months, and you expect the dollar to weaken in that time. So both cases you need to protect yourself. As an importer, if the dollar strengthens against the rupee, you lose money. But in case of an exporter, if the dollar weakens against the rupee, then you're going to get less money. Suppose I have exported, at the time of export, the dollar is 83, but suppose the dollar index cools down and comes back to, say, below 100, so we may touch 80. So when I'm getting my payment, I will be getting it 80. Though at the time when I exported, it was 83. So I will be losing 3 rupees per dollar. And maybe my whole of my profits will get wiped out. Okay. So in that case, usually we go to a banker, and I remember, when I was almost like 25 years or 26-year old, I started working in a company called Grasim, which is owned by Birlas. So, my boss called me and he says that, we have to make a payment. We are importing a lot of stuff, and we need to take a forward cover from a bank. So I was clueless because I haven't done that thing earlier anytime. So, and I was, in Gwalior, not in Delhi. So I don't know whom to approach. The banks, it was about 30 years back or maybe 25 years back. I don't know exactly. So I had gone to State Bank of India, which is the biggest bank in Gwalior, and asked them whether they can cover our these things. So they said our head office does the transactions, so they will get back after some time and let us know what kind of a rate they can quote. But anyway, eventually we cover ourselves. So there's a forward contract which you can go to the bank and take a contract. Okay, normally it is uh, you know. Uh, it's called basically. It's not done through the stock exchange. Okay, it's across the table, or what do you say? I mean, there's a particular word. Okay, so anyway, so then we talk about the futures contract. Okay, instead of going to a bank, you can do it today. Nobody goes to the bank usually. You can always go to the bank, but now you can even sitting at home, even if you're a student or you're doing business, you can from your laptop you can hook up to the terminal and to the stock exchange terminal and do it yourself. For example, if you're working, I mean you're taking an education abroad, like you're gone for an MBA and you are exposed to pounds, you have to make up money in Canadian dollars or any other currency, so you can take a hedge yourself through the stock exchange window. So we'll talk about that. So that's called futures contract, and we'll be going to talk about that. And then the options contract. Okay, so both are done through stock exchange. Okay, contract is linear product, and options basically is a contract which will give you a better handle to cover yourself, and we'll talk about that when we reach to that options. Then we have swap contracts. Okay, so we're going to talk about those things which are a little bit complicated instruments. So we are going to talk more in detail when we reach to these two instruments. Okay, so a forward contract. Yes, yes.
Forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date.
So forward contract is a customized contract. First of all, it's called customized contract. Okay, I'll explain you how. Why? Between two parties to buy or sell an asset at a specified price on a future date. Just to give an example, I mean, out of this currency context, suppose I go to the market and I like something, like a TV or a fridge or anything. Okay, and now it is expensive. Suppose it is 2 lakh rupees. Okay, and I don't have that money with me, and I'm expecting a payment of 2 lakhs, say after 1 month. Maybe like I'm expecting a 2 lakh rupees of income tax refund, which is yet not come. I'm just waiting for it. Okay, so I'll ask him. I'll come after a month. By the time I'll get the money, and I will take this item. I mean, whether it's a fridge or TV or maybe a good computer. So he says, okay. So he, enters into a contract with me. Maybe a verbal or maybe on his, on a piece of paper, he says, you come after a month, I'll supply you this at the current rate. Whatever rate we have decided today, I've negotiated with him. Okay, he asked me, 2.5 lakhs, and we were able to negotiate to 2,10,000. But I said, I'll make you the payment after 1 month, and I'll pick up the thing also after 1 month. I'll take the delivery as well as I'll make the payment after 1 month. So he, makes a recording of that on a piece of paper, and we both sign, and I, move out. So after a 1 month, I'll go to him, show him the paper, the contract between me and himself, and he'll deliver me at the price at which it was agreed. So it's a forward contract, is a customized contract. It has been customized to my needs. It's not standardized. Okay, fine. So it can be done for any customer for whatever the terms can be, I mean, change or everything can change. Okay. So there is no fixed format about the forward contract. A forward contract, yeah, please. Yash, can you read?
A forward contract can be used for hedging or speculation, although it's not standardized. Asia makes it particularly apt for hedging.
So now, normally a forward contract is very good tool for hedging. Okay. Now, apart from hedging, you can even speculate against, certain currencies. Fine. You can even speculate. If you expect the dollar to go up, so you can take a position in dollar. Okay. That is normally done in the stock market, but in a forward contract, it is mainly a hedging tool. Okay. You can't speculate. Okay. So bankers will not allow you to speculate. If you have an underlying transaction, either an importer or exporter, then only they will entertain you. Okay, fine. Otherwise, they are not going to give you a quote for a certain currency if you don't have any business. You're not in a business of, you're not exposed to the transaction. Your underlying transaction is not there, then they will not give you a contract. Okay. So a forward contract can be used for hedging or speculation. Of course, it is written speculation, but a forward, contract is very seldom used for speculation. Although it's a non-standard in nature, makes it particularly apt for only hedging, because it's a customized contract, so it is very good for hedging. Okay. As we go along, you'll understand, this customized and non-standardized, because when you do futures, then you will, it will make sense, because these are all standardized contracts there. Okay. Okay. Read.
A currency forward is a customized written contract between parties that sets a fixed foreign currency exchange rate for a transaction that will occur on a specified future date.
Now, basically, suppose I require dollars, okay, fine, or I require pounds or euros. So I go to a bank, okay, I require it, say, in the month of December. So I'll ask a quote at what price he's going to give me a dollar or a pound or a euro in the month of December. So he's going to give me a quote, okay, and then we are going to fix that and enter into contract. I'll come in the month of December and either take delivery of dollars or give delivery of dollars. If I'm an importer, then I'll take delivery of dollars, because then I have to make the payment to someone. Or when I get dollars, I'll give him the delivery and he'll actually give me that rate. So both ways, as an importer exporter, I can take a forward contract. Okay.
The future date for which the currency exchange rate is fixed is usually the date on which the two parties plan to conclude a buy or sell transaction together.
Okay. So normally, it get conclude. It happens to culminate at the time when actually the transaction plays. Like, if I go to the bank in December, though I had gone to them now and fixed the rate, but in the month of December, I'm going to conclude that transaction. Okay. Okay. So just read them. It's self-explanatory. I'm not going to talk about that. Just read that.
A currency forward is a customized written contract between two parties that sets a fixed foreign currency exchange rate for a transaction set for a specified future date. Currency forward contracts are used to hedge foreign currency exchange risk, and they are most commonly made between importers and exporters headquartered in different countries.
Okay, is it okay? Is it clear? Now, please pay attention, because next week there's going to be a quiz from this. So if you miss out what I'm saying, you will lose your marks at that time. So please be attentive. Whatever we do today and whatever balance portion which is left in the next class, immediately there will be a quiz. So if you listen and then watch a video, then nothing you have to do. No more thing. Okay, you don't have to go and just read my slides again and again. Nothing. Okay, just pay attention. All the things will be coming from here only. Okay, just read it.
Currency forward contracts are primarily utilized to hedge against currency exchange rate risk. It protects the buyer or seller against unfavorable currency exchange rate occurrences that may arise between when a sale is contracted and when the sale is actually made.
So the first two boxes are clear. Is it clear? This is, whatever we have just covered up to now. Okay. Third one, last one.
However, parties that enter into a currency forward contract forego the potential benefit of exchange rate changes that may occur in their favor between contracting and closing a transaction.
Okay. Read the third one and try to visualize, what he's saying. Okay. In this slide, just read it. Can you make a sense of the last box? Can you just explain, if you get an idea what it means? And if you understand that, you understood. Very good. Because then it will help you one other quiz also. One question would be directly on account of that. Yeah. What's your name? Huh? Aryaman. Aryaman, tell me what's this thing?
Sir, so basically, currency forward contracts, like you mentioned in the first slide, are used to hedge against the risk of the exchange rate going down, your currency going down and some sort of risk happen. Yeah. But when you do that, you also forget the opposite case of the currency going up. Absolutely. So you would lose out on an opportunity to make money also on the forex exchange. Yeah.
Suppose you are an importer, for example. You can be an importer, exporter, it works both ways. Now you're an importer, you have hedged yourself. You went to the bank and took a forward contract. and he said that I will give you dollars at 83 rupees to be paid to your paid to your supplier, okay, because you're going to give him the money. Now, when you go to a on that day when you are supposed to make the payment, suppose the dollar goes to 85, then you are very happy because you are getting the dollars at 83. But suppose the dollar is at 80, then what happens? You know, if you should have not taken a forward contract, it would have been better that you would have waited for the spot rate and paid your money at 80 rather than paying at 80. So losing that 3 rupees, gain which you would have got. Okay. So that's a downside of a forward. Is it clear? Similarly, for an exports also it may work both ways. Have you got it? Faiwas. क्या नाम है आपका? What's your name? Faiwas. Huh? For visa. For visa. Okay, okay, sorry. And what's the first name? Second name? Huh? Zakaria. For visa. For visa, Zakaria. Okay. Very different name, okay. For visa, Zakaria. But you have not been attending, missing the classes from the last two occasions. You have not attended, na? Last class you were not there. Okay. You have watched the video? Okay, great. So, so the third box, have you got it? The third box? Okay. For visa, Zakaria. Okay, great. Okay, now let's talk about forwards are not standardized. They are not standardized. Okay, as I told you, they are not standardized, but the futures are standardized. Okay, so we'll talk about the standard. You will come to know why you're saying it's not standardized. Okay, the term in relation to contract size, delivery grade, location, delivery date, and credit periods are always negotiated. Now, for example, it is not only for currencies when you enter into a forward contract. Suppose I am in a company. Okay, I'm working in a company and I'm holding a position, and I'm in a commercial department. I'm supposed to buy for example coal, okay, or cement or steel or anything. Now, steel may have various grades, A grade, B grade, C grade, or certain numbers to the grade. Now, if I enter into contract with someone, so I have to specify which grade I'm going to buy from him, at what price, on what date. Everything is fixed today. Okay. If I tell him that you are going to sell me this material, say after 6 months at this price, so he's going to deliver you that thing on that day. So you decide about the grade, location, where I want my goods. Okay, if I buy it, in my factory, or I buy at say Bombay or Delhi, so rates can change. Okay, so I can talk about location, delivery date, credit period. So I can say I will pay you after 6 months. So he may just give me a price according to that. Okay, a forward contract. Fine. Now so these contracts are very important for business people because business may you always enter into such kind of a contracts with your suppliers or with your customers. Okay, always all businesses do that. I remember my father who had never gone to a school. He was born in Pakistan, and he migrated to India, and he was doing a business. What kind of business? A restaurant business, and in South Extension, Delhi. So we had a very good restaurant there. So he had entered into a contract with someone, okay, that time, to buy all the stuff, like all vegetables, all groceries, all non-veg like chicken, mutton, poultry, and everything, and all the rates were fixed for the whole year. Tomatoes at 1 rupee a kilo for whole year. Whether the tomato goes to 10 rupees or 20 rupees or 5 rupees or whatever, the delivery is going to get a 1 rupee for whole year down, because he is placing a big order. So he had negotiated with someone. It was called a forward contract. He was not doing that. Actually, he's entering into a forward contract. Okay, but that was a forward contract. So, so here the forward contract is not standardized, because anyone can decide about what kind of product he wants, which location, what grade. Okay, then read this.
The forward contract, the buyer of the contract draws its value at maturity from its delivery terms or a cash settlement. On maturity, if the price of the underlying is higher than the contract price, the buyer makes a profit. If the price is lower, the buyer suffers a loss, and the gain to the buyer is the loss.
Suppose I gave an example. So the tomatoes, instead of 2 rupees, they came to just 50 paisa. Then my father would be losing, okay, because he's still buying at $2. Okay, so if it goes up, If the tomatoes are selling at 10, he has contracted someone to supply at ₹2, so he's happy with that. Okay, so there will be, can be a loss or gain to you, but eventually it will be good for you because now, because when you are setting your menu card at what price you're going to charge to your customers, you don't have to fluctuate it every now and then, because then this is the price I'm going to pay for the whole year. So you remain with the price, and your customers are also happy that they're getting at the same price. The prices of the certain things change dramatically, particularly the prices. The prices of the certain things can change from $100 to just ₹1 also over the time, okay, or ₹5. So whatever. So here basically the gain or loss will happen. You can understand what I've explained that. Okay, next. Now we do some questions. Okay, fine. So please pay attention. The first question, I just kept one or two tricky questions, and they're the simple ones. Okay. To start with, there's some questions it requires a little bit of understanding. Fine. Okay, just read it. Yes.
The Australian exporter will be receiving $500,000 in 1 year's time.
Okay, an Australian exporter will be receiving US $500,000 in 1 year's time. So he's an exporter, Australian exporter. He'll be receiving 5 lakh US dollars from his customer. Okay, fine. But when he's going to receive? After 1 year. The spot rate today, Australian dollar is $1 is equal to how much? 0.7020/25. Okay, so there are two rates given to you. The spot rate is $1 today. Of course, today's rate has no meaning for him because he is going to get the payment after 1 year's time, isn't it? But the rate is given. Fine. So $1 is equal to 0.27020 or 25. Do you understand this code? Those people who don't understand the code, please relate them. I'll explain that. But I just want to check that what is your understanding. Now, this is, suppose if you have to, buy Australian dollar, what is the rate applicable to you? Suppose you want to buy Australian dollars. If you want to buy an Australian dollar, uh, 25. Yeah, 25%. Yeah. So this is the ask rate and this is the bid rate. This is the bid rate, this is the ask rate. So if you want to buy something from the bank, so they will give 0.7025. But if you want to sell Australian dollar, then the rate is 7020, 0.72. Okay, fine. So the banker will always give you two rate code. One is called the bid and one is called the ask. Ask is always higher than the bid. Ask is the price which is applicable generally to the importers or the people who want to buy the foreign currency. Or if I want to buy a foreign currency, suppose I am traveling abroad, this rate is applicable to me. But when I come back, I have got dollars with me, I want to sell it back, so this is the rate. Or it is for exporter. If an exporter, I will be having that currency, I'm going to surrender, so the bank is going to give me this rate. Is that okay? Is it clear? Now, 1 year forward margin is given as 50/45. Okay, 15/45. So generally the quotes are given like this. The full quote is not given, but the margin is given or the swap point is given. Okay, so you need to basically use this as well as this to arrive at the forward rate. Okay, fine. Now, since the bid has to be lower and asked to be higher, but it is the other way around. Meaning what? Meaning what? Meaning is that the Australian dollar would be trading at discount, not at premium. इसका मतलब ये है कि Australian dollar will be at discount, not at premium. That's why the forward margin is the jumbled one. Okay, and normally if you read the forward margin, it will be 45/50. Normally it will be like that. Okay, if the Australian dollar would have been gaining ground over the time against the dollar, but normally a dollar always gains ground against most of the currencies. Assuming that this is one Australian dollar course. Australian dollar is weakening over 1 year's time. Okay, if this is the way, then uh, you have to minus. Okay, otherwise you have to add. So here, now we will understand when we do the question. What will be the Australian dollar proceeds be if it is hedged? Now, if this guy who is going to receive $5 lakh, he is an Australian exporter, he can take a cover. he can go for a forward cover. So how much money in terms of Australian dollars he's going to receive? So this is what saying that suppose if I take a cover, then how many Australian dollars I'm going to receive? Second is, if at the end of the year the spot rate is this, what would be the Australian dollar proceeds if unhedged? Suppose I don't look at that rate, I just wait for the 1 year to go down, then I'll be getting my money at this rate, isn't it? So you need to calculate how many Australian dollars he's going to get. Okay, and then finally the question would be, would the exporter be better off hedged or unhedged? Okay, fine. Is that okay? So let's just do it. Now, so first is, what will be Australian dollar proceed if it is hedged? Okay, an Australian exporter will be receiving 5 lakh dollars in 1 year's time. Okay, the spot rate is this, which is given in the question, and 1 year forward margin is given. Okay, so far the question has been repeated. Now let's go to the answer. The forward rate will be like this: 1 Australian dollar is equal to the quote 0.7020 minus 0.0050. So because those are the last points, okay, for 50, 45 is basically 0.0050 and 0.0040. You have to add that and then minus from the quote. The 50 and 45 is the last two digits of the quote, okay. So when we minus it and then we arrive at this rate. So 1 Australian dollar would be actually depreciating against the dollar and the rate will look like this. Is it clear? Okay, fine. Is it okay? Yeah. Uh, you're talking about this or this? This is again 0.7020, 0.7020. Then this rate will become 50. Okay, and put it as 0.0050 because this 0.050 represent these 2 points. Okay, here. Okay. We have to add or less from these 2 points. So we can make it compatible with that. Okay. So we are dividing this maybe by 1,000 or something like that and arriving at 0.0050. Okay. So we are now we have to minus because we know that the Australian dollar is weakening against the rupee, against the dollar. But had it been written as 45.50, then it would have simply added. Okay, had it been written, it was 45 and 50 here, then Australian dollar would have been strengthening against the dollar. In that case, the answer would have changed. We would have written instead of minus, we would have been adding. Okay, so we are just minusing it and arriving at the rate. 1 Australian dollar would be equal to so many US dollar. Is that clear to everyone? Clear? 100%? Okay. Then, now, what we do is, we get the rate of 1 Australian dollar. 1 Australian dollar is equal to so many US dollar. But actually here what we are going to receive, we are going to receive 5 lakh dollars. Okay, the quote is not in order. This is a dollar, Australian dollar buy or selling rate, not dollar buy or selling rate. So in that case, what we will do, we will convert that into dollar quote. Okay, how do we do this? This will divide, this will become the bid and this will become the ask, but the reciprocal of it. Reciprocal of this will become the bid. Reciprocal of this will become the ask. So how we have done it? So the $1 will be equal to, now we can write it in a dollar quote. Okay. What we have done, we have 1 divided by the ask, which will become the bid rate. Okay. When you are buying dollars, it is equivalent to selling, Australian dollars. So it's just the opposite of it. Okay. Like when we go and want to buy dollars, we are selling rupees. When we are selling rupees, we are buying dollars. So it's just the opposite. So we are doing the reciprocal of it to convert back into the currency. Okay. So $1 is equal to so and so. Is that okay? So what we do is we just look at this 1 divided by 0.6980. Do it on the calculator. 1 divided by 0.6980. Do it. Okay. And you will get this rate. You will get 1.4326. And do the other one, 1 divided by that rate, you will get. And just jumble it. Okay. What was written in the bid will go to ask. What was written in the ask will come as bid here. Okay. So the rate of $1 will be equivalent to this. Now, who am I? I'm going to receive $5 lakh. So I'm going to go to the bank and say convert my dollars into Australian dollars. Okay. So which means I am an exporter. So this rate will become applicable to me. Right? Because I am going to get dollars and I am going to go and give the dollars to the bank. I am not going to go to the bank and ask you for dollars. When I ask and buy dollars, he will give me this rate. But when I'm going to sell my dollars, he is going to look at this rate. Now this rate is always higher than this rate. Right? That rate is 47, this is 26. If I have to buy, I have to pay more, okay, in terms of dollar, Australian dollars. If I am, this is what? This is a code of which country? Australia. Because on this side it is written Australian dollar. This is the code of buying $1 in terms of Australian dollars. So if I am an Australian, I will be looking at this is a that code of buying $1 in Australia. Like when you look at India, $1 is equal to 83 rupees. So 83 rupees is coming on the right hand side. This is my currency rate. Okay. If I have to buy $1, I have to pay 83. Here, if I have to pay $1, I have to pay. If I have to buy, I have to pay this. If I have to sell, I'll have to pay this. Okay. I'll just explain here again. Suppose $1 is equal to rupees 82 to 83. Suppose this is the rate which I get quote. Suppose I am an Indian and I am looking to buy. I can be either buying dollars or I will be selling dollars. Suppose I am traveling abroad. I will be buying dollars. So what is the rate applicable to me? This one. Right? So I have to pay 83. Suppose I come back and I have got some children with me. I have to surrender it. That guy will say, suppose the rates remain the same, he will say, I'll give you 80 rupees back. When you left, I charge you 83. When you are coming, I'm going to give you only 80. Suppose I buy dollars and immediately sell, I will lose money. Suppose I do this and immediately I got a call, my trip get cancelled. I go back to the foreign exchange dealer. I say, I don't require dollars, please convert them. So I will expect 83 rupees. No, he's going to give 82 rupees. Because he says the rate applicable for selling dollars is 82, for buying dollars is 83. So similarly, here, now I am actually in Australia. For me, the currency exchange, $1 is equal to so many Australian dollars. So if I have to buy Australian dollars, I have to buy dollars, I will be paying that rate. If I have to sell dollars, I will be getting this rate. So in this case, I am an exporter. I have got $5 lakh with me. I am sitting with $5 lakh. Okay. So this is the rate will be applicable to me. Zubain, after long time, हो गया आपका खत्म हो गया वहाँ? Yes sir. Okay. Good. So there were almost 10 students. Only 3 students have joined. Where are the others? आ रहे. Okay. अच्छा क्लास चल रही है. So you did your future and options. पूरा हो गया अभी है. This is the first class.
Sir, this is the first class of options.
Options. अच्छा you started with options. खत्म हो गया था options. Good. So we are into the forwards and then we're moving to the futures. Okay. After some time and maybe options the next time. So this is the rate. Okay. Fine. So we multiply this 5 lakhs into 1.43. So this is the Australian dollars he will be getting. Is that okay? Is this okay? Because he has got 5 lakh US dollars and he is going to convert them into Australian dollars. So he is going to get this rate now just for this thing. Now this is a quote, you are an exporter, okay, and you are going to get 5 lakh US dollars. Now you got it. So you go to the bank and convert them into Australian dollars. So since you are an exporter, so this rate is applicable. This is the bid rate and this is the ask rate. Okay. So if you have to buy dollars, then this is the rate. If you have to sell dollars because you have them, so then you will get it. So you are going to get this is the rate. Okay. Fine. Is it clear? Is it clear to all? Now the second option was that that was the forward rate. The second option is that you don't hedge yourself. You wait after 1 year. Whatever is the rate, that will become applicable. Suppose if the end of the year, the spot rate is 1 Australian dollar is equal to so and so rate. Now you are not taking a hedge. Okay. Now you are going to get your money. So you are going to First convert the quote into dollar terms by doing the reciprocal. Okay, I have done it already. So then multiplied with your applicable rate, which is 1.422. Now here the rate is 1.42. There was the rate was 1.43. So you're getting 7,11,000 Australian dollars as against 7,16. So which is better? Hedging. Hedging is better. So that means the exporter is better off if he was hedged. Is that clear? Is it clear to everyone? Now let's participate for the second question. So again the similar question. Okay, but uh, okay, this is the same question. Uh, ABC. So please understand this is a very important and very good question. Okay, ABC Limited of UK has exported goods worth 5 lakh or 500,000 Canadian dollars. So this is a UK company, and they have exported goods to Canada. How much? Worth 500,000 Canadian dollars. And this money they will get after 6 months. Fine. Okay. Now the exporter wants to hedge the receipt in the forward market. So who is the exporter? ABC. Now why he would like to hedge? Because if 5 lakh, he's going to get 5 lakh Canadian dollars. If the Canadian dollars are going to depreciate, or rather, what will happen here? Uh, if suppose you are an exporter, and if the dollar, now suppose you are here, okay? Suppose you are exporter. If the dollar appreciates, okay, against the rupee, and you are exporter, you are going to make money. But if the dollar depreciates, then you are going to lose money. If it is going to come down to 80 bucks, then an exporter you're going to lose. Or rather, other way around, if the rupee depreciates, okay, fine, you're going to lose money. If the rupee appreciates, what way? The rupee appreciates, you're going to lose money. If the rupee depreciates, you're not going to lose money. Okay, so let's understand here. So the exporter wants to hedge. So let's come to the point, and then you will understand that. Okay? Let me just wait for that thing. Okay, the exporter wants to hedge the receipt in the forward market. Okay, fine. The following information is available to you. Spot exchange rate is Canadian dollar 2.5 oblique pound, which means 1 pound is equal to so many Canadian dollars. If you have to read this, it means one pound is equal to 2.5 Canadian dollar. Okay. The interest rate in UK is 12% and interest rate in Canada is 15%. Okay, fine. Okay, fine. Now, if the Canadian dollar, just to come back, if the Canadian dollar weakens, then he's going to lose the money as an exporter. Okay, fine. So he's expecting the Canadian dollars to weaken. That's why he has gone to the market and he wants to cover his risk. He wants to take a forward cover. Fine. Okay. Sure. Okay. So this question I'm just starting again. Some students have just joined in. So we are doing forwards. Okay. And then we move on to the futures and next time to the options. So what we are doing forward. You are just attending to your forward and futures this thing class, all of you. Okay. So it's just continuation of that. That was the stock market. This is the currency market. Similar thing, but in different market. Now, ABC Limited of UK has exported goods worth 5 lakh Canadian dollars or 500,000 Canadian dollars. So this is the guy who is going to get 5 lakh Canadian dollars after how many months? 6 months. Okay. Now, if the Canadian dollar weakens, he is going to lose money. Okay. So he needs to cover it in the forward market. The exporter wants to hedge the receipt in the forward market. The following information is available to you. The spot exchange rate is $2.5 oblique pound. So that means 1 pound is equal to 2.5. So please listen it carefully because there's going to be a quiz next time. And if we miss out something talking to each other, then you lose marks. And the quiz will be such you have to complete within 5 minutes. You can't do anything but similar 10 questions, okay? Rapid questions. Fine. And submit. It will be in Google form. Generally, people try to Google and find the answer, though answers you won't get. So I'll give you just 5 minutes to answer the question, 10 questions, okay? Fine. Only one try. So please listen, otherwise you'll lose out. Abhi tak you have been all getting good marks. I just shared the marks. So here, chances are only you'll get good marks if you listen to the lecture. Otherwise, you won't get. Okay. So this lecture is getting recorded. So students who have joined late, they can always listen to the lecture at home. Okay. Fine. That's why I'm just sitting here. I'm not moving out because you can just listen to the lecture. Otherwise, if I move around, then my voice will not get recorded. Okay. So here, what we are saying is this is the exchange rate which is given to you. Okay. Interest rate in UK is 12%. Interest rate in Canada is 15%. The interest rate in Canada and UK is given to you. Okay. Fine. Now, it can be interest rate or it can be inflation rate. And we all know the countries which have a higher inflation rate, those currencies depreciate against the stronger currency. Like as an Indian, our inflation is normally higher than the American, inflation. That's why we have been always, depreciating against the dollar. Or dollar has been appreciating over the long term. Okay. So now, according to this information, which currency is going to depreciate? Canadian dollar, because there their inflation rate or interest rate is 15% and UK is 12%. Okay, fine. And roughly how much? 3% per annum. The difference between the two. 15 minus 12 is 3%, isn't it? So Canadian dollar is going to weaken against the UK dollar by 3%, fundamentally, as per the parity theory which is there. Okay, fine. Normally it will happen like that. Not, but market can always go here and there. Okay, market may disregard these interest rates also, but over a long run, this is going to be the situation. Now, the forward rates truly reflect the interest rate differential. Now he says that the forward rates truly reflect the interest rate differential. So that means whatever is the interest rate differential, they will hold good. So the pound is going to appreciate by 3% against the Canadian dollar. Okay. Find out the gains or loss to UK exporter if the Canadian spot rates, number one, declines by 2%. Okay. So how much is the Canadian dollar spot rate declining by? 2%. Whereas, as per the interest parity theory, how much would have been declined? 3%. But for annum. Here we're talking about 6 months because the question says 6 months. 6 months, remember. In 6 months, how much would be the decline? 1.5%. Fine. But actually, it has declined by 2%. Even if I take a forward cover, I am hedged by 1.5%, but I'm going to lose half a percent, isn't it? I'm just telling you before solving it, you can just think about how the answer would come like. Okay, fine. अभी कैनेडियन डॉलर जो है डिक्लाइन हो गया 2% एक्चुअल में, बट आपने एक फॉरवर्ड कवर ले लिया था जिसमें तो 1.5% ही डिक्लाइन का रेट मिलेगा आपको, क्योंकि द इंटरेस्ट रेट डिफरेंशियल आर ट्रूली रिफ्लेक्टिंग द फॉरवर्ड रेट. सो वट एवर रेट यू अराइव एट इट विल बी covering only 1.5% of your loss. So you'll be losing another 0.5%, even if you take a forward cover. Okay, is that okay? If the Canadian dollar gains by 4%, then what will happen? No, if no, that's okay. If it gains by 4%, will it? There will be a loss, a big loss. 1.5% तो फॉरवर्ड रेट से लॉस होगा और 4% जो गेन हुआ वो भी जाएगा, तो 5.5-6% का लॉस हो जाएगा अगर फॉरवर्ड कवर ले लिया था. ओके, सो उसने बोला अगर 4% गेन हो जाता है तो क्या होगा? सो देयर विल बी अ बिग ह्यूज लॉस. Now tell me this thing: if it remains unchanged in next 6 months, okay, what should be done? Will you gain or will you lose? क्या होगा? You will lose. Absolutely right. Good, wonderful. Because it has remained unchanged. Okay, it has remained unchanged. Okay, so you are going to lose because you are taking a forward cover. You are actually buying the current dollars at 1.5% decline. You have entered into contact with someone from the rate, but actually it has not changed at all. So you're going to lose. So the forward cover is not going to help you. Okay, so let's talk about it. Let's see one by one all the answers. Now the rate is like this: 1 pound is equal to Canadian dollar 2.5. This is the rate which is given in the question. I'm just putting it in a line. Is that okay? Because the rate was given as Canadian dollar 2.5 oblique pound. So 1 pound is equal to 2.5 is the rate. Okay, fine. In which currency you are going to get your money? Is it going to be Canadian dollars or pounds? Canadian dollars. So again, the quote is not in right order. Okay, fine. Remember that you have to reciprocate it whenever time comes. Okay. Now, interest rate in UK is 12%, interest rate in Canada is 15%. So, which means that this is the 6-month forward rate. How you are going to do is, you are going to take the rate 1 pound. The rate was 2.5. This rate is how much? Canadian dollars. Okay. Or I will write it here. Now, 1 pound equal to Canadian dollars 2.5. Is this the currency rate? It is given or something else? Here. Okay. Now what we do is we multiply this. Suppose you have to calculate the yearly rate. Then I will do 1.15 divided by 1.12 to arrive at the forward. This is the formula. Okay. We will see the formula in the next slide. So it is forward rate is equal to spot rate multiplied by 1 plus interest rate of home currency, 1 plus interest rate for the foreign currency. Okay. So if I arrive at the forward rate, okay, of 1 pound, then I will do this for 1 year. But since I want to do it for 6 months, I will divide this by 6 and this by 6. So this is written as 0.075 and 0.06. Okay. So what I have done, 1 pound is equal to Canadian dollar 2.5 into 1.075 divided by 1.06, because I am interested to find 6 months forward rate, not the 1 year forward rate, isn't it? Fine. So yeah. So I have to calculate 1.06 and then divide the two. They are wrong. Because first we have to divide and calculate the number and then divide. Sometimes you are dividing everything by 6. It doesn't matter. I'm not going to teach you mathematics. Go here and puzzle about that. So do it. Then you divided by 2, so not divided by 6, but divided by 2. Yes, that's the right correction. So this will get divided by 2. Because I have only 6 months, right? Or the 12 divided by 6. So it will be just follow this, okay? What I am doing is here, I am taking, don't forget about those calculations at the moment, just come back to this. So this will be 1.075. What I am doing is, I am taking 15 dividing by 2, so I am getting 1.075. Here I am taking 1.12, instead of 1.112 divided by 2 is come to 1. Forget about the calculation, just think about the logic, okay? Otherwise, we can all get confused when we are trying to explain that, okay? It may happen sometimes. Anji? हाँ मैंने क्या बोला था the rate is how much 15% per annum 15% per annum for half year it will be what 7.5%. Fine. For half year the rate will be 6%. So what I have taken is 1.075. Fine. So if you say there will be a 10% increase, so you multiply by 1.1. If it is a 7.5%, you are going to multiply by 1.07. What I am doing here. Here I am taking 1.06. Okay. So I am arriving at the 6 months forward rate, which is 1 pound will be equal to 2.535. Is that okay? So this is going to be my 1 year forward rate. Is it clear? Is it clear, Zubin? Is it clear? Everyone followed? Okay. Now, so this is how I explain. I mean, you can just go through the slide. The formula is given, how we arrive at the rate. Okay. Then 6 months forward rate will be like this. Is that okay? higher than the ask rate. Where also to build it, ask rate is high. Here there is only one rate which is given. 1.52. There is no bid and ask rate here. In this quotation, there is no bid and ask. There is only one rate. Okay. Fine. Is that clear? Then now let's do it. Okay, the question. Okay. Now, if the Canadian dollar rates decline by 2%, what happens? Now, I am going to take a forward cover. The forward cover is going to cost me £1 is equal to 2.535. Okay, fine. But I have got Canadian dollars. So I am going to divide this to arrive at the number. I'll do the reciprocal. If I take one Canadian dollar is will be equal to 1 divided by so many dollars. So what I'm doing is just simply dividing, cutting short. Okay. अगर मुझे इसका रेट निकालना होता तो I would have done 1 divided by 2.535 to arrive at 1 Canadian dollar is equal to pound. So this I would have done. So what I have done is I have just simply taken Canadian dollars divided by 2.53. So how much I am getting? 1,97,000. Is that clear? Suppose there was no depreciation, no appreciation, I would have got 2 lakh pounds, isn't it? If the rate would have been just 2.50, which was originally, I would have got 2 lakh pounds. But now, since I have taken a forward cover, I will be getting 1 lakh. Now, what happens is, if it declines by 2%, what happens? It declines by 2%. So that means the rate goes to 2.55. Actually, what happened? After 6 months, the rate was 2.55. I would have got 1,96,000. If I have not taken a cover, I would have got 1,96,000. So which means this divided by 2 point. So what I am doing is there is a appreciation of pound by 2%. So I am just simply going to multiply by 1.02. So I get the rate here. Okay. And then I divide this with 5, I get this much. So what is better? This or this? This is better or this is better? If I have taken a hedge, I am getting this money. If I am not hedged, I am getting this money. How much I am, gaining? I am gaining because of the forward contract, 1161 pounds. Is that clear? Now we can't complicate things in a question. Okay? Is that okay? But when you are taking a forward cover, at the time the interest rate will be the same. It can't change. You go to the market and say this is the interest rate. It's not that you are going after one day you are going the interest rate can change a little bit. But on that day, the forward cover is going to cost you and you are going to get this much after 6 months. You take the forward cover today, whatever is the rate that is fixed. Even if it changes after 6 months, even if it changes the next day, doesn't going to matter. Because you are going to get this much of money after 6 months based on the forward cover. Whatever happens subsequently to the interest rates, to the inflation rate doesn't matter because you have entered into a forward cover. Then what happens is after 6 months, the pound has actually declined by 2%, because the gain since the forward rate assumed a decline of 1.5%, but actually decline is 2%. Last line, gain since the forward rate assumed decline of 1.5%. वहां पर 1.5% आपने decline ले लिया था. You are going to suffer a 1.5% loss that was destined because you are taken a forward cover. But actually the loss happened to be 2%, which is not going to come to you. You are not going to suffer that because you are protected by a forward contract. Is that clear, everyone? Okay. So, gain due to the forward contract is 1 month, 6 months. Is that clear?
So, basically rating of half 0.5% extra.
Ajit? No, you are not getting it. You are getting it. Extra. 0.5% extra. You are getting 0.5% extra because you have covered yourself. Actual loss is 2%, but your actual forward loss is usually only 1.5%. You are happy by 0.5%.
But in the contract, 1.5%, you should be only getting back. Huh? In the contract, intentions be 1.5% you will come with. So you should be only getting back. What happens when you went to the bank? When bank will not say 1.5% something like that. Bank will give you a rate. He will say, I am going to give you 2.5355. I am going to give you, this is my rate. I am going to, give you $10 at 2.535 per pound. You come to me, I am going to give you that. They are not mentioning 1.5. The rates are reflecting the interest rate difference. That is the market reality. That whatever is the interest rate differential, that is getting inbuilt into the forward contracts by the banks. Bank says that exactly the forward contract would actually, coincide with the interest rate differentials. It is just by by coincidence. Fine. You go to the bank and says that this is the rate I am going to charge, and then you work out the interest rate differential. Comes to that. That has nothing to do with the forward contract. But in the question it is written that the forward contract is actually coinciding with the interest rate. It is not writing that you get to 1.5%. It's not right. So when you went to the customer, when you went to the bank gave you this rate.
Is that clear? Okay. Now it happens that the pound has actually depreciated by 4%. Pound has actually depreciated by 4%. But you are expecting the Canadian dollar to depreciate, but the pound has depreciated by 4%. So what happens is that
You are going to lose 11,094 because in this case you would have got 2,08,000 pounds if you have not taken a forward cover because the pound would have appreciated. Sorry, the Canadian dollar would have appreciated. Fine. Here the $10 is appreciated, that the $10 gains by 4% or the pound depreciates by 4%. One the same thing. So here the rate was 2.5, I multiplied 0.696, you get this rate, new rate. Now, as per this rate, if I divide this by 2.4, you get 2,08,033 pounds. Is that clear? अगर आपने कवर नहीं लिया होता तो आपको 2,08,000 पाउंड मिलते. You would have got 2,08,000 pounds. But since you have taken a cover, you are getting only 1,27,000. So how much you are losing? 11,000
pounds. Is that okay? Is it this clear? Zoben, is it clear? No.
Sir, just here, I have a question. The forward rate only incorporates the difference in the interest rate, right?
Haji?
The forward rate, the formula would be 1 plus interest rate
Ah.
equals 9%. That only accounts for interest rate, not for exchange rate.
that account for the interest.
Exchange
When
rate.
you go to the bank doesn't know what will happen after 1 year or 6 months. They look at the interest rate, the difference between interest rates. So they should have some mechanism to give you a forward rate. Normally they look at the interest rates, okay, and give you a quote accordingly. Think about that. But the day-to-day interest rates, day-to-day foreign exchange can change because of the demand and supply of the dollar versus pound. Fine.
So they will give you one spot rate of the exchange rate, and they give you the forward rate, and you will everything.
So forward rate, interest rate differential will give you an exchange rate for the forward.
Or you can choose to do nothing and 6 months get the buy spot.
Or
You can choose to
not to and just wait for the actual thing to happen. Instead of taking a forward cover, you wait for the time. And suppose here, what was the right course of action? What was the right course of action? Tell me. He should have waited or not? He should have waited or not? Why? Normally, if you always can do the average, it's okay, fine. Fine, because even I get it. Okay? So here, if you are waited, you would have got this much more. But since you took a forward cover because you were expecting the Canadian dollar to depreciate, okay, significantly, but the forward rate was telling you 1.5 depreciation, so you said, okay, fine. But it happened to be other way around. The Canadian dollar appreciated. अगर आप exporter हो, just think about if the dollar is today 83 and it goes to 89 or 90, as an exporter you will gain.
If the dollar, if the rupee would have depreciated, we have gained. In this case, the Canadian dollar has appreciated, you would have gained, isn't it? So gain up to value because you have taken a forward cover and you're using 11,000. Is that okay? Now, the last one. If it remains unchanged, if it remains unchanged, you would have got the original rate interest 2.5 जो theory में आया था, तो 5 lakh divided by you would have got 2 lakh pounds. But since you went into a cover, you lost 2,761 pounds. Is that okay? So, is that clear? Fine. So it is always better to reserve all your questions at the end. Otherwise, everybody get confused. Okay, just reserve the questions. All this at the end. Okay, just hold the questions and ask me at the end because your questions are all very valid and they are all very intelligent questions. I can tell you that. Okay, but just reserve them at the end. Okay, is that okay? Break हो गया time? नहीं. Okay, so is that okay? हाँ. Which one? अगर अनचेंज होता देखो अनचेंज था तो you would have got the full 2 lakh pounds. But the pound, here what happens? The spot is at unchanged. Fine. You were expecting the Canadian dollar to decline or the pound to appreciate. Fine. So you are assuming a decline, you would have got only one. आपने 1.5, you are expecting the Canadian dollar to what? Decline. So actually it has not declined, it has remained the same. So your board cover has assumed that, so that's why you do. Is that okay? Now, you just go through the slides and just run the logic again and you will find the answers for yourself, okay? Is that okay? एक question और कर लेते हैं and then we'll have a break. Is that okay? Or should we have a break? Which one? What do you want? A break or a break? Okay, because the next question is a little bit more dicey. And then we follow a very smooth path thereafter. So 12:21, so 12:41 will come meet again. So come in time, I'm going to start at 12:41 sharp. Just hold, stop.